Hello, good morning, good afternoon, good evening, wherever you are in the world. I'm Nicolas Véron. I'm delighted on behalf of the Peterson Institute to introduce this new session of the financial statement series. And we'll discuss central banks and whether they're doing too much or going too much into the details of the economy and capital allocation, and especially credit allocation. For this today, we'll have Steve Cecchetti and hopefully Signe Krogstrup. I'm saying hopefully because she hasn't joined us yet, but we're hopeful that she will do so in a few minutes. Steve Cecchetti is one of the most knowledgeable specialists to discuss our topic today. He studied at MIT, did his PhD at the University of California at Berkeley. In the mid-80s, he taught at the Graduate School of Business Administration, of New York University. So now it's called NYU Stern. And in 1987, he moved to Ohio State University. And from there in 2003 to Brandeis, where he's now at the International Business School. His full title, I'll have it all, is Barbara and Richard M. Rosenberg Professor of Global Finance. He's also got a number of visiting faculty appointments at Oxford, at Melbourne University, at Boston College, at Princeton University, and perhaps even more importantly for our purposes today, he's also had a career in central banking. He was a visitor at the Federal Reserve Bank of Kansas City in 1986. From 1997 to 1999, he was an executive vice president and director of research at the Federal Reserve Bank of New York. And last but not least, from 2008 to 2013, for 5 years, he was the economic advisor and head of the monetary and economic department. So in plain English, the chief economist at the Bank for International Settlements in Basel. In this function, he was actually the predecessor to Yun Shin, which we hosted at the previous session. So there's a little bit of a Basel streak this year in the financial statements series. He has countless academic credentials, which I'm not going to mention all here, but Steve Cecchetti in particular is the author initially and later the co-author in the later edition of the definitive textbook on money, banking, and financial markets, which is pretty much the scope of this web event series. The last edition was co-authored with Kermit Schoenholz at NYU Stern, and Steve also has a blog with Schoenholz called inevitably Money and Banking. Signe Krogstrup, who hopefully will join us soon, is a truly international policymaker. She is a Danish national. She studied economics initially at the University of Copenhagen. She did her PhD at the Graduate Institute in Geneva, and from there she went on all over the world. She was in the early 2000s an economist at the United Nations Economic and Social Commission for West Asia, which is in Beirut, and then she was back in Geneva at the Postgraduate Institute of International Studies, and here she joined us. Hi, Signe, I'm talking about you. In 2008, she joined the Swiss National Bank, and she stayed there until 2015 in various positions, mostly in economic research and monetary policy. Importantly, as I always say in those presentations, most importantly, from 2015 to 2016, she was a visiting fellow here at the Peterson Institute for International Economics in Washington. And we had a lot of discussions, and then she joined the International Monetary Fund in the research department, where she stayed for 4 years. In mid-2019, Signe went back to Denmark, full circle, at the National Bank as head of the Economic and Monetary Policy Department. And a couple of months ago, in November 2020, she became one of the 3 governors of the Danish National Bank. That's her current position. So with this, Steve, over to you.
Well, thank you very much for that generous introduction. I am going to share my slides, hopefully. And now I will make them full screen for you, I hope. There we go. So thank you for that kind introduction and for including me in this extremely valuable series of discussions into the challenges that central bankers and financial policymakers are facing. You're providing an important public service, and it's an honor to participate. The subject today is an issue I think of perennial importance, and that is, what is the appropriate and legitimate role of unelected technocratic central bankers in a representative democratic society? Now, over the past dozen years, this question has become more complicated and more difficult to answer. Now, to foreshadow my answer, I believe that that policy actions of the past decade, and especially over the past year, have blurred the lines between monetary and fiscal policy almost beyond recognition. By risking central bank independence, I think this fiscalization, as I'll call it, of central banks weakens its ability to deliver on its primary mandate of price stability and financial stability. And to find a way back to the pre-2007 division of responsibilities, we would need to establish, or we do need to establish, I think, some clear limits on what central banks can and cannot do. Now, recalling the world before the financial crisis of 2007, 2009 may seem quaint, but it provides, I think, a useful benchmark from which to start. Now, the premise of the world then was that financial conditions influence real economic activity. And central banks control the price of their own liabilities, namely reserves. These are the safest, most liquid assets. And by controlling those, they ultimately control the benchmark that is off of which maturity, liquidity, and credit risk are priced. The central bank controls financial conditions then, and it controls the real economy. Now, this process, though, relies on markets operating efficiently with few frictions so that arbitrage works at least most of the time and reasonably well. Now, this brings me to what I will call stage one of the change, which is 2007 to 19. The first thing is that frictions clog the transmission mechanism from safe to risky assets, weakening the link that central banks were exploiting in trying to influence and stabilize the real economy and inflation. Indeed, financial conditions at one point turned sharply adverse despite conventional policy easing. So it became difficult to control. Central banks responded by intervening directly in a wider array of asset markets, ranging from long-term sovereigns to privately and quasi-publicly issued fixed income securities, and in some cases even listed equities. And when private intermediaries became dysfunctional and stopped being able to serve their fundamental purpose, the central bank substituted its own balance sheet for those private intermediaries, and then took over part of the private financial system, in effect, at least temporarily, in an effort to influence financial conditions and meet its stability objectives. Now, importantly, in this first stage, though, most of what central banks did was done directly through financial intermediaries. Now, this had this consequence that everyone, I'm sure, on this webinar today knows, which is that that central bank balance sheets grew dramatically. Here I've drawn the growth in central bank balance sheets as a percent of GDP from the mid-2007 to the end of 2019, which I take, as I say, as the first phase. And the Fed's balance sheet grew by 13% of GDP, the Bank of England by about 20, it's hard to compute exactly quickly, the Eurosystem by 26, and the Bank of Japan on the far right of this picture is a clear outlier. In many ways, it was sort of breaking the path for what would come next. Now, this brings us to the second stage, which is the pandemic shock. Now, additional obstacles to transmission of policy led central banks to react again. First, they put back in place everything that they had taken away, if they had taken them away from the previous episode, and then they enlarged what they were doing, they expanded it. But they also went further. They started providing credit directly to the non-financial sector. This meant increasing purchases of corporate bonds, and in the case of the Fed, creating a mechanism whereby the Fed could actually buy bonds that were issued by local governments, something they hadn't done before. The objective was to increase credit supply and directly using lending programs to further substitute the central bank's balance sheet for what was going on in the real economy, and substituting for the private intermediaries. Now, this had the again relatively well-known impact of further increasing dramatically the size of central bank balance sheets. And that's the red bar here. And just comparing 2007 to the most recent numbers, the central bank balance sheets that accounted for 15% of GDP in 2007 were now 25% in Canada, 60% in the Euro area, and in the mid-30s in the Federal Reserve. Again, the Bank of Japan is leading the way at in excess of 125% of GDP. Not totally coincidentally, government debt has been growing along with central bank balance sheets. In this chart, I compare the increase in central bank balance sheets, that's the black line, with the increase in government debt, that's the red line. Prior to the pandemic, except in the Euro area and Japan, the black line is quite a bit lower than the red line, meaning that the central bank balance sheet increase was quite a bit smaller than the increase in net government debt. During the pandemic, however, the expansion of central banks' balance sheets absorbed between 2/3 and 125% of the increase in government debt. Now, I think that's an important thing to keep in mind as we look at this.
Just for clarification, sorry to interrupt you,
No problem.
the US figures, presumably you say 2020, so that includes everything passed under Trump, but not the current plan under consideration, right?
No, that's correct. This is through the end of 2020. So it will. So this does not include 2021. That's exactly right, and that's because the data on government debt is hard to get at more than a quarterly frequency across all. This is net government debt from the IMF, so it is not just federal government debt.
Right.
Okay, so the question we have to ask is where this leads us. What happens if central banks continue down the road that they seem to be on, further broadening their interventions directly and influencing an ever wider range of financial markets and asset prices? The answer, I think, is that the central bank becomes an allocator of credit. The state starts to allocate credit, and it risks destroying the dynamism of the economy and damaging long-run growth. And surely, I think this is not what central banks intend as a goal for their stabilization efforts. Now, to be fair to central bankers, they're under tremendous political pressure to expand their mandates. I think not only that, but in a world of low interest rates and low inflation, at least for now, fiscal policy has become the primary tool for stabilization, something that's a bit surprising to many of us. And under these circumstances, it's extremely tempting and very efficient to use the central bank as the fiscal agent for the government, which is one way of interpreting what I was just showing you in that picture. Now, the danger is that when conditions become more tranquil, it's going to be difficult for central banks to halt the use of these new tools that they fashioned in crisis. They could do this. They could continue this intervention, I think, either through direct asset acquisitions, which, as I said, is tempting, or through a collateral framework that distorts relative prices of debt, which is something that's gone on in a lot of places for some time. The political pressure, as I suggest, to support these non-financial entities directly is unlikely to recede anytime soon. Now, the expansion into quasi-fiscal actions comes with a significant political component, I think, comes with a tremendous risk. To be clear, though, before I finish, it's important not to confuse central bank balance sheets with the expertise of the central bank. Some people have claimed that the central bankers have technical and operational capacities that naturally lead them to do the things that they've been doing, and that they should engage in these operations because of that. I take issue with that conclusion. I think that you can use the expertise of the central bank without putting the things on the central bank balance sheet, and that's the way that we should do this. Credit operations should not be on these on the central bank balance sheets, either directly or through the special purpose vehicles that are used to actually circumvent certain parts of U.S. law. So what should we do? First, it's fiscal authorities that ought to make unavoidably political choices that directly influence resource allocation. Now, governments already have a myriad of institutions that provide credit. For example, in the United States, the government has loan guarantee programs for housing, for farmers, for small businesses, and for college students. We should not encourage unelected central bankers to decide the scale and mix of programs like these, and we shouldn't conceal the programs on the central bank's balance sheet when they're fundamentally fiscal in nature. Now, if pressed, I would probably agree that if central bankers are to allocate credit, maybe they shouldn't be independent at all. So if you're going to do this, then central bank independence, I think, may not be appropriate. But without an independent central bank, who's going to safeguard price stability? We know that it's very hard for politicians to do that. Or when faced with potentially imminent collapse of financial systems, who's going to act in the public interest to provide liquidity as the lender of last resort and the like? So to ensure the central banks can do what they were designed to do, we need to place limits on the scope of what they can do. I will stop there, and I will stop sharing my screen. Thank you for indulging me.
Very clear points, very clear view to kickstart our debate. And now over to you, Signe. Welcome.
Thank you so much, and sorry about being late in the meeting. I must admit that in my agenda it is set for 9 o'clock European time tonight. So I just got this email. I was in the middle of a meeting, and I was completely confused. So now I'm here.
Thanks for making it.
Yeah, it was lucky that I was watching my inbox in this meeting. But thanks so much for inviting me, and I think that it's great to be back. I wish it was in person at the Peterson Institute, and I hope that will be possible soon, but this is a good substitute and a very good occasion. And it was a very interesting presentation that Steve provided with, and very provocative, and some core issues that I think we will be discussing over the next many years. And I just wanted to remind everybody that I am from a central bank where we have we're pegging to the euro. We have not been engaging in QE or other unconventional policies. So these issues are, in exactly the way that they're addressed here, are not so relevant for us, but of course they are relevant broadly to the central banking community. And I think that there are some issues that I want to put on the table before we start discussing them. There are related issues that are relevant for all central banks, including ours, and I will end my points with that at the end. But just first 3 points on what Steve had to say that I think are important when we discuss the role of central banks in capital allocation. And the first one is that I think the background for central banks engaging in all these types of measures is really important in this discussion. And that is that we, after the global financial crisis, major central banks cut their interest rates dramatically and hit what was considered the effective lower bound on interest rates back in 2009. And that was the time when central banks started to engage in these alternative policies or unconventional policies, for instance, QE and other measures that Steve has been talking about. And we cannot separate the fact that we hit the effective lower bound from the central banks engaging in these different types of measures. And when we start discussing whether central banks should indeed be involved in these different types of measures, I think that it's also important to keep in mind that the tool, the standard tool, and maybe the tool of preference is currently not really available. There are gray zones there, and we can discuss negative interest rates and the like, but that's not what the issue here. The issue is that tool is not available at the moment. And so central banks are, of course, looking for other tools because they still have mandates. Someone still has to safeguard price stability, as Steve mentioned at the end. And they have been doing, many central banks have been doing that using these types of measures that have led to balance sheet expansion. And I think the important point here is that they have been doing that in order to live up to their mandates, not despite the mandates, but in fact, in order to live up to the mandates. And when we discuss limiting tools, we also have to keep in mind that such limits could prevent central banks from being operative in meeting their mandates. And I think that the discussion it's important, rather than thinking about what central banks should not be doing, I think it's important to think about the situation that we're in with an effective lower bound. What should central banks be doing in order to meet their mandates? What are the appropriate tools? How should they be used? In general and in crisis situations. So that's my hope for the discussion that we have, is that we also take this more positive approach to discussing what is the right thing to do, not just what is the wrong thing to do. A second point, when we have this discussion, is that it's very important not to compare apple and oranges. Central banks engaged in a lot of different types of balance sheet expansion policies, and they're not all alike. They're in fact very different. And with the risk of simplifying or oversimplifying, I think we can divide into two types of policies. And here I'm leaving, again, negative interest rates and forward guidance. I'm leaving those types of policies out, but just looking at balance sheet expansion policies, we can roughly put them into two overall baskets. One is QE in safe assets with the aim of affecting the term premium and affecting the slope of the yield curve, in fact, operating on the long term of the yield curve instead of the short term of the yield curve. And on the safe yield curve, that means that yield curve that's used for pricing off other assets. So that is a standard QE, and it's usually done in government debt, because in many countries, government debt will be the most safe assets. And that's not the case everywhere, but that is often the case. And when we think of these types of policies, it is not clear that it is so different in terms of allocation of capital than standard monetary policy. And then there is a second bucket, and those are balance sheet expansion measures, and they don't even have to expand balance sheets, but measures that will work on spreads. So affecting certain types of asset classes opposed to others, affecting credit spreads. These are very different, and we should clearly separate the two types of policies when we're discussing the allocative effects of these. And I think it's an important question. I think that when we are discussing the effect on capital allocation and perhaps on asset prices, it's really important to also ask the question as to how much are the central banks really doing that? What is the scope of what we're discussing here? I think that's not clear. And a third point that I think is, again, important in this discussion is the fact that monetary policy is interacting with fiscal policy and affecting financing conditions is not at all new. And again, I want to refer to these types of QE policies that are affecting the long end of the yield curve instead of the short end. Monetary policy is about setting interest rates, and setting of interest rates has always interacted with government debt financing. And that indeed is the main purpose in the nutshell of, if we can say that, it's one of the purposes, at least, or one of the reasons why we have this importance of central banks having clear mandates and independence to reach them. Because it is not, central banks are not, usually not, their mandate will not be to finance the government debt. Currently mandates are revolving around price stability or other macroeconomic stabilization goals, but not to finance government debt. And that has historical reasons. We don't want to get into the debt inflation spirals. And that is indeed the case when we conduct standard monetary policy outside the effective lower bound. And it is indeed still the case when we are conducting QE and working on the long end of the yield curve. There is that interaction. It has to be managed. It's managed best in ensuring that central banks are adhering and targeting their mandates and that they have their independence to do so. I think those are 3 points that I think are important to keep in mind when we are discussing these issues. And then I want to leave you with a last reflection, and that is where I come from with discussions that I'm having when we're talking about the role of central banks in allocating capital. I think some issues are very much high on the agenda, and those are climate change and inequality. Those are two very important issues, and I think that they will be discussed a lot in the coming years. They're very different, the two. When we talk about inequality, we're talking about how the central bank is actually, as a byproduct, affecting inequality. And when we talk about climate change, the considerations are now, what role should the central bank take in allocating capital toward the appropriate green investments that are needed for transition. And herein comes a very important question as to what is the mandate really of the central bank in terms of this. How is climate change affecting the current mandates of central banks? Should central banks do more or less according to those mandates? And what should they be doing? Which tools do they have? And in to what extent are the tools that central banks can use, to what extent will they be quasi-fiscal, as Steve said? And therefore appropriate. And I have some clear views on all this. These are just questions that I'm bringing up. But I think that when we're talking about capital allocation and central banks, these are some important questions to also have in mind. And I will stop here. I think I'm already far out of time. And back to you, Nicolas.
But that was fabulous. Thank you so much for it, Signe. And I will come to the audience's question. By the way, you can, as you know, as usual, ask questions using the Q&A tool of Zoom. You can also raise your hand if you want a microphone. I do that selectively, but happily. So looking forward to your questions. We have a very knowledgeable group of attendees today. But just to kick it off, Steve, why is it that we should look back with fondness at the past before 2007? What was intrinsically better there? And isn't it the case that central banks have allocated credit for times immemorial? If you take the long view, central banks have done that almost all the time. So what is there to the period just before 2007 that makes it so precious?
Well, I guess that the answer, again, I mean, first of all, I agree with most of what Signe has said. I'll take issue with a little bit of it, but not much. It wouldn't be fun otherwise. But I think that the point that I'm trying to make is that we should have is that the central bank mandate is creeping, and that I think a lot of this, the claim that we need to intervene in markets in order to ensure monetary policy transmission, which is the claim that's been made, I think is not always borne out by the facts. I think that we do need to separate monetary and fiscal policy a bit more cleanly. Nicolas, as you point out, we haven't necessarily done that in every case. I mean, I would point to the Eurosystem's collateral policy and much of what went on in Europe, even with the NCBs before the monetary union, as being a case.
Central banks.
Pardon me? The national central banks. The national central banks of the Eurosystem prior to monetary union, prior to 1999, as having a lot of credit allocation aspects to it. But I would also say that that there has been an effort, at least, to move to a more asset neutral position in the use of the central bank's balance sheet. And so I think that's where I would come down, is I think that asset neutrality is an important principle and that everything else, in my view, is fiscal policy. I may or may not agree with the choices of the fiscal authorities, but they are elected officials, and I think that it is their purview to have tax and subsidy policies and to choose winners and losers if they so like. But that's not the case, I think, for an independent central bank. I think.
But I guess at a kind of philosophical level, I mean, you could say that the central bank mandate is narrow, but it's also very wide, right? Because price stability is everywhere, and in a way, this permeates the entire economy. So if they have to defend price stability and also financial stability, doesn't that mean that they should do whatever it takes, even if that involves credit allocation?
Well, I don't think it would normally. And I think the answer to that is no. I mean, I think that if you start doing fiscal policy, then you should not be independent. And because then you are essentially doing what elected authorities do. So I think that things that involve that have dramatic distributional impacts, the central bank should not be in charge, for instance, of setting a carbon tax. If you want an independent authority to do that, that's fine, but not the central bank. So that would be a great example of something that I think would be a disaster for the central bank, is put them in charge of carbon taxation.
I don't know if anybody is listening to us from Karlsruhe, but we have a question from Athanasios Orkanidis, himself a former central banker, and it's exactly about this, on climate change action. So it's actually two questions. One is for Signe. Despite pegging the exchange rate, the Danish National Bank can still engage in credit allocation along the lines that Steve mentioned: collateral rules, subsidizing the liquidity value of green versus brown assets. So what are you considering? I mean, Denmark is known for its windmills and leadership in climate change action. And the second question from Athanasios is for Steve. And he makes a case, one can argue that central banks are well suited to do this for the same reason, this meaning, green climate change action, for the same reason that they can protect price stability. They have a long horizon. So why shouldn't they be in charge of something which is too long-term impactful for the political cycle to manage? Signe.
Yes, thanks a lot. So that's a very broad question, of course. And let me say that we have a peg, and we have that's our main target, and we have been able to defend that very easily with the tools that we have using the interest rate. We have negative interest rates at the moment. They have been sufficient in order to keep the peg. We have been doing interventions in the same way that we have been doing in positive territory. So we have not needed to adopt alternative or unconventional measures in order to reach our target. That doesn't mean that we couldn't do it, as said. And the big discussion and push, I think there's a big push from the public for central banks to play a role because of certain desperation on the green transition not being quick enough. So we're meeting these calls for central bank active policies. And I think that we're not done thinking about all these things, and I think that we won't be done for a long time. But I think I'm very much in line with what I think Steve would also say here, is that as soon as we start doing credit allocation with the goal of, for instance, of financing green investments, we will step into a fiscal space. This will be these will be quasi-fiscal policies, and so we would do that, but it would be second best. In my view, that would be second best compared to using tax subsidy tools and fiscal tools to achieve the same thing, and with a democratic legitimacy in doing so. So,
but to echo Athanasios, isn't that intrinsically a second best thing, that politicians cannot act long term, so central banks or independent institutions have to?
So there are, and I'm not going to speak for other central banks, but and I think that there are some gray zones, and I think for climate, gray zones will keep emerging, because these are about market failures, and there could be market failures that are squarely in the financial system, and that central banks are closer to and maybe could address. But I do think that to keep it clean, the fact that we don't have taxes and tariffs or whatever could be used in order to achieve the allocation of credit toward the goals that we think are correct. The fact that we don't use fiscal tools is that is because we have the political democratic institutions have not chosen to go down that road. That doesn't mean that they shouldn't. I mean,
as a French citizen, I have searing memories of when the Macron government started raising carbon taxes and got the Yellow Vest movement in response. So I guess in that case it was not for lack of trying.
So the point is that if central banks then step into that space because there are political reasons or political economy reasons that it's not done with the tools that would be appropriate, then we step into a political space where I don't think that central banks belong. That is stepping outside our mandate and stepping into a political space where we will be subject to the same political pressures. And I do think that that is not where I would want to go with a central bank that has a clear mandate.
Stephen, what do you have to answer?
Well, I think I agree 100%. I think the argument I was making a few minutes ago is that central banks have stepped into the breach because of a failure of a political system to actually do what needed to be done in the original financial crisis. I think that's certainly true in my country, and it's true elsewhere. I think that's a terrible precedent. I think it's something that we should really move away from. And I think to do it in the case of climate policy would be a disaster as well. Now, let me be clear. I care deeply about the climate. I think climate change is an incredibly important problem. I think it's something that we absolutely have to face. The question is whether or not the central bank is the place to face it. And if, as Athanasios says, we need to have a longer time horizon that most politicians have, which seems to these days be about 20 minutes, then maybe we need a separate independent institution that actually sets climate policy in some way with a clear mandate that is set by the politicians and accountability for that mandate. To set a mandate, to have the central bank have a mandate that it meets carbon neutrality, that the economy meets carbon neutrality by some year, seems to me to be just ridiculous. And so I take issue with that. Also, I have things to say about green QE and stuff as well, but those are different.
Okay, Signe?
Yes, can I just add that it's also important for me to say that I'm bringing up the issue of climate change. The reason why I do that is because I care deeply about the green transition, and I think that we should all do everything we can to get there. And so I actually did spend quite a lot of time thinking about what the appropriate role of central banks are in the green transition. And I don't think that we should be going into the realm of credit allocation, but I do think that there are many things that we can do within our mandates, because climate change and the green transition will affect our mandates. They will affect price stability. They will be affecting especially financial stability. And central banks are already doing a lot on that account, looking at financial vulnerabilities to climate change. And just the fact that we are focusing on these things and bringing our attention to the risks in the financial system that come from climate change and from the green transition, we can do quite a difference. And I think that it's important that we go down that road, because that is actually consistent, if not even demanded, in our mandates.
Right. We have a comment from Göran Hjelm of the Swedish Fiscal Policy Council. It's not really a question, so I read the comment. Central banks can very well engage on climate issues, but only on direct political command, these words. They cannot engage because politicians fail. So if central banks have tools that the politicians lack, transfer these tools or let politicians govern these tools. So I guess that was intended as a compliment to what you said. Let me move to a slightly different point. We have questions from both Pablo Perez and Juni Aaltonen on central banks as market makers, and especially the episode we had in mid-March last year, when essentially, Steve, the So banking regulations that you drafted, that your neighbors in Basel at the Basel Committee drafted, have gotten banks out of the market making business to a large extent. So central banks have filled the gap because somebody had to do that, right? So what do you say about it? And you're on mute.
I'm on mute. Yes. Well, that would make my answer easier, because that's a difficult question. I think that we do need to think much harder, especially as more economies try to make transitions to increase market-based finance, to what the role of central banks should be in ensuring the liquidity and the functioning of markets. I think that was quite a surprise what happened in March in the U.S. Treasury market was quite a surprise, and I think it was clearly within the mandate of the Federal Reserve to actually intervene in that market in the way that they did. But I think as we had this discussion in one of your very, very good earlier episodes of Financial Statements with Peter Fisher and Anil Kashyap, where the question there is, the central bank, the Federal Reserve bought $800 billion worth of Treasury securities very rapidly in early April of 2020, and then the question that you can sort of understand, although that's a lot, but the question is, why did they continue after that? But I do think that we need to think. I don't have a clear answer, but we need to think much harder about how to structure a market maker of last resort to ensure that the central bank can backstop markets that it believes are essential during times when they do seize up.
And by the way, that session with Nicolas Véron and Peter Fisher, like all the past sessions of Financial Statements and of other Peterson Institute series, especially Trade Winds by Annabelle Gonzalez and Global Connections by Caroline Atkinson, they're all on the website and available for replay. So I have to advertise this. I think it's intended for you all as a resource. Signe, what about market making? And should there, as Steve just hinted at, be a kind of broader reflection on how to structure a market maker of last resort if central banks are not well tooled for it? You're on mute. You're on mute, Signe.
Sorry about that. I think I don't think I have much to add to that discussion. I think I very much agree with Steve's points, and I think I will leave it at that. Okay,
so let me move to more technical matters, but they're important and not that technical when you know the technicalities. Very political, Gottfried Gruber asks about the respective merits of quantitative easing versus yield curve control wouldn't yield curve control, as the Japanese central bank has been engaging in, be more targeted and hence more efficient? Maybe Signe first on this one.
So there are advantages and drawbacks to both. So I will not be the judge of what's most appropriate. And I think it also will depend on the specific central bank and the specific markets in which they operate and the political situation. But clearly, yield curve control, you will target a specific price, and that will be, if you're able to do so, of course, that will be more targeted toward the financial conditions that you're trying to achieve. Whether or not that's appropriate, yes, I would leave it up to the individual central banks.
Very cautious answer. Steve.
My time at the BIS taught me to give answers like what Signe just gave, which is, I'm not going to tell every individual central bank is different, and so answers to questions like that, like the exact appropriateness of certain policy instruments and certain balance sheet structures, depend on local conditions.
Now you can even say bad things about central bankers.
In this case, I think that QE, pure QE, to the extent that it works, that's great. If you want to target long-term interest rates, we've seen successful instances of people targeting long-term interest rates. I think what you need to think clearly about if you're going to do yield curve control, however, is exit. And the way in which it's implemented then from the very beginning matters quite a lot. Governor Brainerd of the Federal Reserve Board has suggested that you could do yield curve control by targeting a specific bond that then became shorter and shorter in its maturity until it rolls off. Something like that is clever because it has an automatic exit. But as I said, I think that if you're going to do yield curve control, because it would, as Signe said, directly control the interest rate that you ultimately care about, then you do need to think about exit. Because if you buy tons of 10-year bonds and you say that you're going to have zero interest rate on 10-year bonds forever, then how do you stop doing that?
Signe, any comment on that?
I fully agree with Steve's comments.
Okay, so Ted Truman has another question. He asked whether Steve would make a distinction between the use of special purpose vehicles backstopped by the fiscal authorities in the case of rescues and the policies directed at particular markets. And obviously we have several examples in mind here, but perhaps one of those, I don't know if that's what Ted has in mind, he may want to comment, is what the Fed did with Bear Stearns at the very 6 months before Lehman, at an early stage of the great financial crisis. Steve.
Okay, so this is really technical and deep into the plumbing of what the Federal Reserve does and the interaction of the Federal Reserve and the Treasury and how it is that the Federal Reserve Act is written. And Ted knows all of that. He knows it better than I do. So in fact, this is almost a question for him to answer. I think the answer is that I'm made quite uncomfortable by the way in which these special purpose vehicles have been used recently to create the Main Street lending facilities and the municipal bond lending facilities. These are municipal bond liquidity facilities and the corporate bond liquidity facilities, because these are directly to lending to the non-financial sector and the private and public non-financial sector. If those were administered by the Treasury, which is how I would have structured them, so I would have said, oh, this is something, we'll get it started because we know how, but after six months, it belongs to you. And we can lend to it, but you administer it, I would feel much better about it. But I think that it's an evasion of the Federal Reserve Act. It's an evasion of the Dodd-Frank attempts at amending the Federal Reserve Act. And so I think we should think pretty hard about it.
So unlike Tim Geithner, you like the Dodd-Frank attempts at the Federal Reserve Act, right?
I don't like them. I think they were a mistake, but they were a part of what the Congress did. I live in a democratic society with legislation.
Okay.
Again, as I said, I don't have to like it, but I should.
As an academic, you're very entitled to having your opinion.
No, I don't like it. I think it was a mistake. I think it was an error. I think the adjustment of what's called Article 13.3's lending authorities that was included in the Dodd-Frank was not wise.
Ted, I think you're listening to us. If you want to speak in response,
Signe wanted to comment on this. I think she.
Yeah, but just telling Ted that if he wants to respond, he should raise his hand. Signe.
So I wanted to ask another question. So I will let you discuss this finish first, but I wanted to raise another question with Steve.
Ted is not raising his hand, so go ahead.
So Steve, it's clear that, and I think I agree with many of your points. But what I would love to hear from you is how you see central banks in this current effective lower bound environment. How do they optimally conduct monetary policy when the short-term interest rate is unavailable? What are the types of instruments that they should be using now, given that mandates have not been achieved, and then we still have inflation rates that are still below targets?
And by the way, we have a question from François Suarez on this too. What are your thoughts on another way of yield curve control, like just controlling the short end and issuing shorter duration bonds requiring higher frequency rolling?
So I think that, I mean, these are hard questions, and so So fortunately, I haven't actually been forced to do this. So I get to answer the questions without having to live up to what I say. But I would again try to stay away from private issues, try to stay away from non-sovereigns, and try to stay away from and try to remain as neutral as I possibly can in financial markets when they are operating. So I have no, again, I may or may not agree with the scale of what the Federal Reserve's doing. I may not agree with the scale of what the Euro system is doing. But I think that to shy away from the purchase, to move away from the purchase of sovereigns is itself a problem. Now, this of course brings up the issue.
But sorry, Steve. What makes a distinction between sovereigns and non-sovereigns that fundamental? Isn't it a matter of degree more than nature in a way? I mean, I may be influenced by my Eurozone background here, but at the end of the day, both sovereigns and non-sovereign issuers are part of the financial system, and that's what central banks look at.
Right, but why should I choose one? Why should I choose one sector, one firm over another? To come to a point that I think is maybe closer to Signe's heart than to mine, it turns out that carbon-intensive industries tend to issue way more debt than non-carbon intensive industries do. This is a historical fact. It's also because service industries don't issue much debt, and they also don't have very large carbon footprints. So it turns out that if you are neutral in terms of financial market issue of corporate debt, you are skewing towards the financing of high carbon industries. Now, I guess you could do that, but it doesn't seem, that turns out to be maybe that's a second order thing in your view. It's not so much in mine, but it is a fact.
But so, don't you have that everywhere? I mean, in a way, if you have a policy across the board, you're going to distort it one way or another for reasons such as the one you just mentioned. And therefore you have to correct one, and that becomes credit allocation.
But I guess my point is that I would rather effectively finance the government through the purchase of government debt, and then let them subsidize industries, given their accountability to the public through their elections, than I would have the unelected technocratic central bankers do it. You know, central bankers have very long terms in most countries, and not a whole lot of accountability ultimately when it comes to the potential to replace them.
Yeah, but they have a mandate, and that includes monetary policy transmission. So I mean, we're going in circles here, but that's what the session is about. Signe.
So I'm glad that Steve brought up this point about market neutrality, and that the fact that we're ending up, if we buy the whole market portfolio, we will end up buying much more debts that, for instance, of carbon emitters. And this is one of these gray zones, gray points where it's not so clear anymore what's right and what's wrong. I just want to add that I think I agree on principle with Steve's point that it would be better to be able to buy the market portfolio, allocate money to the government, and that they would do the allocation. But it's these are issues that are currently being debated and probed a lot, and I'm very much looking forward to following the debate. I don't think we have the last words on these issues yet.
Peter Andrews is asking, is there anything central banks can do to help asset managers with credit allocation? Any of you want to answer that one?
What, could you say it again?
Is there anything central banks can do to help asset managers with asset allocation? I'm just reading the question.
I think their goal is to not help.
I'll take another one, which is very prominent in my home country of France. David Liebeg is asking if you have a view on debt cancellation, as it is now discussed in the euro area. Probably that one is for Signe. Should national central banks cancel national debt?
So could you repeat the question, please?
Well, I mean, it's a pervasive debate these days in France because for whatever reason, a lot of people are saying that the euro system should cancel whatever share of the sovereign debt it holds that is related to COVID-19 because COVID-19 is an act of God. And therefore, we would end up with much lower and healthier sovereign debt ratios. I'm not sure I understand the argument, but it's an argument that's made a lot. Any comments?
It doesn't sound enticing to me, but I don't want to comment on a proposal that I don't know the details of, and I must admit to not knowing the details of that. But just canceling debt someone has to pay for that debt. The question is who will be canceling it? Where's the debt burden going to go?
I agree. I don't understand the mechanics of the proposal, which I think is maybe another way of saying what Signe just said. If there are losses on the asset side, which would come from cancellation, what happens to your liabilities? I mean, it is certainly the case that central banks do not have to have positive capital. We've seen a lot of examples worldwide of central banks that have negative net worth. So is the point here to make the central banks have negative net worth so that they don't have to? I don't know. I mean, another option, of course, is that the central banks in the euro system just simply commit themselves to rolling over the assets that they have. And given the way in which the standing facilities work, if we have positive interest rates, they basically just pass that through to their liability holders who are making the commercial banks making deposits in the standing facility. That's certainly one possibility. And in that case, the government would never have to pay it back because the central bank commits to never always rolling it over. So let's say another option would be turn that stuff into a perpetuity held by the central bank. That might make a tiny bit more sense, but it's still really weird. And I don't think I quite get it.
And I'm not sure how our listeners in Karlsruhe view that. There's a question from Alexander Svoboda. Any views on how the issue differs, A, as between small countries and large countries, and B, countries geared to exchange rate stability pegging like Denmark and floaters? Floaters on the other hand, of course.
Which issue would that be?
So basically, the issue we debate generally, is there any fundamental difference depending on side and depending on exchange rate regime? Alexander may correct me if I didn't convey his question right, but I think that's what it's about. Alexander actually raised his hand, so Alexander, you've got the floor.
There we go. Good.
I think you should unmute.
He's still muted, I think.
Did I mute him? No, I think he's muting himself. Or not?
I mean, I think while he's there he is.
Alexander?
I can also start off on some of that because I think that many of these issues that we have discussed, they are principles, and there wouldn't be big differences between small and large countries. It's the principle of central bank independence, clear mandates, and the appropriateness of tools, and whether tools are quasi-fiscal or not. So I think that those are general principles that we are discussing. One thing that has been important in Denmark, we have had the question why we wouldn't do QE, for instance. And here it's very clear for us that, first of all, we haven't needed it in terms of our goals of pegging the exchange rate, but also we are pegging the exchange rate. If we are working on one end of the yield curve, we're using our short-term interest rate to peg the exchange rate. If we then start working on the long-term end of the yield curve for other purposes, we would also affect the foreign exchange market. And that's another reason why QE is not an appropriate tool for us. So that makes a bit of difference in the general case. And there are, of course, many gray zones to that answer as well. But that is one example of something that has been a consideration on our side, of course. So
we're getting close to the end of this session, and I would like to end with two excellent and philosophical questions. One is from Arnab Das, who says, aren't we deluding ourselves here? And I think we applies particularly to you, Steve. isn't it the case that money itself and monetary policy are political in nature, and therefore the whole notion of independence from the political process always has been a bit of a fig leaf? My word on his question. And the other question, which I cannot avoid, is the one asked early on by Mark Vail. To what extent do changing views of the likelihood of significant inflation, this is a very contemporary question, to what extent do changing views of the likelihood of significant inflation in view of the absence of significant price pressures, even during periods of strong growth, bolster or undermine the case for enhanced central bank independence? So those two questions, delusion about independence and inflation considerations, you pick what you want, Signe, and then the last word for Steve.
So the fact that monetary policy is inherently political, it is monetary policy, it is policy. So of course it's political. That the fact that it can be carried out independently, I think, is not a fig leaf, and that we have seen that it has been working. And I do think that it continues to be working in this time, despite the challenges, especially of the effective lower bound, and the fact that we have had to take many different and new tools in. We are still working alongside, working on the mandates that we have, and we still have independence. And the interactions between monetary and fiscal policy, again, I can only repeat, have always been there and will always be there. And there will always be also coordination between monetary and fiscal authorities in order to achieve the goals. But the fact that we can allocate a clear mandate to central banks and give them independence to pursue that mandate, I don't think that's a fig leaf. And let me put it there.
Yeah, no, I think I agree with that. I would start by saying that money, to quote Augustine Carstens, who's now the general manager of the BIS, money is a technology and a legal framework. So that's what money is. Credit, on the other hand, is something else, and that's more what I think that central banks are actually trying to influence. As for whether or not independence is a fig leaf or not, I would say that if it is a fig leaf, it's a pretty useful one. And it seems to work reasonably.
Fig leaves can be useful.
Yeah, it seems to be reasonably. It seems to be reasonably hardy, and it's getting us what we want. I would refer. I think I've been very much influenced by Paul Tucker's book "Unelected Power" on this question. I think there are and are not conditions that have to be met for the legitimate delegation of power to unelected administrative authorities like a central bank, and I think the central bank generally meets them. And in fact, many of my complaints at the beginning of this were about central banks moving into areas that I think violate what I see as Paul Tucker's principles for delegation. And on inflation, it would be great to have some inflation. I can't wait. On
this note, which I think it's an apt conclusion for this discussion, which was very thought-provoking. A lot of food for thought. We'll obviously continue to debate about these and other questions, specifically on green finance. We're expecting to have the European Commissioner, Mary McGuinness, in mid-April. And other speakers on ESG. But the next session on March 11 will be with Fernando Restoy and Anna Gelper, and we'll discuss activity-based versus entity-based regulations. That's another long-standing debate on which we will hope to have new views. Thanks very much for attending this session today. Thanks for being faithful to the financial statement series at the Peterson Institute, and have a great rest of your day.
Thanks, Nicolas.
And thanks especially to our two speakers.